When the drop began, it did not look historic. It looked technical. A sudden red candle, then another, then a cascade. Gold fell sharply in minutes. Silver followed even faster. Trading screens lit up. Commentators rushed to explain it. Some blamed algorithms. Others blamed profit-taking. A few suggested rumors inside the banking system, but no one had a clear answer in the moment. For many investors, the confusion was immediate. Gold is supposed to rise during financial stress. Silver often follows when fear spreads. That has been the pattern people remember. So when headlines mentioned renewed pressure inside several banks, and yet metals were falling instead of rising, something felt wrong. The contradiction created anxiety. If gold is a safe haven, why is it dropping during instability? If banks are under strain, shouldn't defensive assets surge? If the system is fragile, why is the insurance being sold? That tension is where this story begins. But to understand what happened, we need to step back from the screen. Because price action alone rarely tells the full story. Markets do not move based on labels like safe haven or risk asset. They move based on incentives, constraints, and survival priorities. And in moments of stress, survival changes the rules. In the first minutes of the flash crash, the focus was narrow. Traders saw volatility. Retail investors saw losses. Social media saw opportunity for dramatic narratives. Yet underneath those surface reactions, something quieter was happening. Liquidity was being pulled. Liquidity is a simple word for a complex reality. It means access to cash, immediate purchasing power, the ability to meet obligations without delay. When banks feel pressure, liquidity becomes everything. Imagine a bank that holds a portfolio of assets, government bonds, corporate loans, mortgage securities, derivatives, precious metals, exposure. Under normal conditions, these assets are valuable. They generate income. They serve as collateral. They help the institution operate smoothly. But when stress appears, the question changes. It is no longer about long-term value. It is about immediate settlement. If counterparties demand additional collateral, if depositors withdraw funds, if funding markets tighten, the institution must raise cash quickly. And the fastest way to raise cash is often to sell what can be sold immediately. Gold futures are liquid. Silver contracts trade in deep markets. They can be sold within seconds. Settlement is standardized. Buyers are always present at some price. So when pressure builds inside the banking system, metals can become a source of liquidity rather than a store of safety. That distinction matters, because what we witnessed was not necessarily a loss of confidence in gold as a long-term asset. It may have been a scramble for dollars. To understand why, consider how modern banks operate. They are not vaults filled only with deposits. They are interconnected balance sheets. They borrow short and lend long. They hedge risk through derivatives. They pledge collateral to secure funding. Their stability depends on continuous access to short-term markets. When those markets tighten, every institution feels the shift. Funding rates move higher. Counterparties demand more collateral. Risk models adjust automatically. Margin calls are triggered. Margin calls are not emotional. They are mechanical. If the value of pledged assets declines, additional collateral must be posted. If volatility increases, required buffers expand. If correlations break down, models assume higher risk. And when that happens, institutions sell what they can. This is where the idea of a safe haven collides with operational reality. Gold may be considered a hedge against systemic instability over years, but in a liquidity crunch measured in hours, it becomes inventory. If a bank needs cash by the end of the day, it cannot wait for gold to fulfill its role as protection. It must meet immediate obligations. So it sells. Retail investors watching the chart see a paradox. Banks under stress. Gold falling. Silver plunging even harder. But inside funding markets, the logic is clear. Cash first. Everything else second. The flash crash becomes easier to interpret when we shift from narrative to structure. Think of the financial system as a hierarchy. At the top sits base currency used for settlement. In the United States, that is the dollar. Globally, it functions as the primary reserve and funding currency. Below that sit bank deposits, then credit instruments, then securities and derivatives. Gold exists outside this hierarchy as a hard asset, but it trades within the system's infrastructure. When stress rises, demand moves upward in the hierarchy. Investors sell lower-tier assets to obtain higher-tier liquidity, even if those lower-tier assets are considered safe in the long run. During the flash crash, demand for dollars increased faster than demand for gold. That is not a philosophical statement. It is a funding reality. This is why the first reaction in many crises is counterintuitive. In 2008, gold initially fell before recovering. In several liquidity squeezes over the past decades, defensive assets dropped during the earliest phase. The reason was not a collapse in belief. It was forced liquidation. The distinction between voluntary selling and forced selling is crucial. Voluntary selling reflects a change in opinion. Forced selling reflects a change in capacity. When leverage is involved, capacity matters more than conviction. A bank may believe gold will rise long term, but if it cannot meet a collateral call, belief is irrelevant. Positions must be reduced. Silver often moves even more violently because its market structure is thinner and more volatile. It responds faster to shifts in risk, appetite, and funding conditions. So what looked like a rejection of safety may have been a signal of tightening liquidity. And that signal deserves careful attention, because if gold and silver are being sold to raise dollars, the pressure is not in the metals market. It is in the funding system. This reframing shifts the focus away from charts and toward plumbing. Financial plumbing is rarely discussed outside professional circles, yet it determines the stability of the entire structure. Banks rely on short-term funding markets to operate. They borrow overnight. They roll positions daily. They hedge exposures through interconnected contracts. Confidence keeps the system fluid. When confidence weakens, liquidity becomes scarce. Scarcity does not appear evenly. It shows up first in margins, then in spreads, then in volatility. The flash crash may have been one of those early signals. Not a collapse, not a systemic breakdown, but a reminder that under stress, liquidity outranks ideology. This matters because many investors treat gold as a moral position, a statement about distrust in fiat currency, a hedge against inflation, a store of value independent of banks. All of those arguments can hold merit over time. But markets do not operate on philosophy. They operate on settlement requirements. And in the short term, settlement requires cash. When we view the flash crash through this lens, the emotional charge begins to fade. It becomes less about betrayal and more about mechanics. Imagine a crowded theater where someone smells smoke. The first reaction is not to preserve personal belongings. It is to find the exit. Even if the smoke turns out to be minor, the instinct is immediate. Liquidity stress functions the same way. Institutions move toward what they need most urgently. That movement can distort prices temporarily. The key word is temporarily, because once immediate pressures ease, underlying trends often reassert themselves. But before we assume that outcome, we need to examine what triggered the pressure in the first place. Reports indicated renewed strain in segments of the banking sector, rising funding costs, concerns about unrealized losses on bond portfolios, questions about deposit stability. None of these issues are new. They have been building for years in a low-rate environment, followed by rapid tightening. When interest rates rise quickly, bond values fall. Banks that hold long-duration securities see mark-to-market losses. If those losses remain unrealized and funding remains stable, the system absorbs them. But if depositors withdraw funds or counterparties demand more collateral, losses move from theoretical to practical. That transition can force asset sales. Asset sales can trigger price declines. Price declines can increase margin calls. Margin calls can trigger further asset sales. This feedback loop is known as deleveraging, and deleveraging rarely respects asset categories. Gold can fall during deleveraging. So can equities. So can bonds. The common denominator is the need to reduce leverage and raise cash. So when metals dropped sharply during bank stress, it may have been less about metals and more about leverage. The subtle but important shift in this narrative is that the flash crash is not necessarily a contradiction. It may be confirmation that funding conditions tightened rapidly. If that is true, then the drop in metals is not the story. It is a symptom. Symptoms point to underlying conditions, and underlying conditions are what we must examine next. Because if liquidity stress is spreading, the implications extend far beyond one afternoon of price volatility. The global financial system is deeply interconnected. Large banks operate across borders. Funding markets link New York to London to Tokyo. Currency swaps and derivative contracts tie balance sheets together in complex ways. When one segment experiences strain, the effects ripple outward. Even if central banks stand ready to provide support, the immediate adjustment phase can be turbulent. That turbulence often reveals structural weaknesses. The flash crash forces us to ask a broader question. What kind of financial system requires selling defensive assets to maintain stability? The answer lies in leverage and maturity transformation. Banks borrow short and lend long. They operate on thin capital buffers relative to total assets. This structure works efficiently during stable periods. It generates returns. It supports economic growth. But it also creates fragility. If short-term funding evaporates or becomes expensive, the model strains. Liquidity facilities exist to backstop this risk. Central banks can provide emergency lending. Governments can guarantee deposits. Swap lines can supply foreign currency. Yet before those mechanisms activate fully, markets adjust on their own. That adjustment can be abrupt. The flash crash may represent one of those moments when markets tested the boundaries of available liquidity. It may not signal systemic failure, but it highlights sensitivity. Sensitivity to funding costs. Sensitivity to collateral values. Sensitivity to confidence. These are not visible in daily headlines. They appear in spreads, in overnight rates, in subtle shifts, in demand for top-tier liquidity. Gold's sudden drop could be read as a window into those invisible dynamics. And that interpretation changes how we think about safety. Safety is not absolute. It is contextual. An asset can be safe over decades, yet volatile over days. It can protect against currency debasement while still being sold during margin calls. Understanding that distinction reduces emotional reaction and increases analytical clarity. So instead of asking why gold failed during bank stress, a more precise question emerges. What does it mean when institutions sell liquid assets during instability? It means the system values immediate cash above long-term protection. It means liquidity is tightening somewhere. It means funding markets may be under pressure. And that brings us to the deeper layer of this story. Because price action alone does not reveal the source of stress. It only reflects response. To uncover the cause, we must examine what changed in the rules of the game. Did funding costs spike? Did collateral requirements increase? Did volatility models force risk reduction? Did counterparties pull back from lending? These are structural shifts, not headline events. And when structural shifts occur, markets behave differently. The flash crash may be the first visible signal that normal relationships are bending. Gold rising during fear is a pattern. Gold falling during funding stress is another pattern. The distinction lies in the nature of the fear. Inflation fear pushes investors toward hard assets. Liquidity fear pushes investors toward cash. Both can exist simultaneously. But in the short term, liquidity fear often dominates. This hierarchy of fear explains much of what we observed. It also sets the stage for the next phase of analysis. Because if liquidity stress is the driver, then we must understand what triggered it. What changed in bank balance sheets? What pressures built beneath the surface? What signals did markets detect before the public narrative formed? The flash crash is not the conclusion of the story. It is the opening signal. A system shock that forces us to reconsider assumptions. A reminder that financial markets operate on mechanics before they operate on meaning. And as we move forward, the central question becomes clearer. What rule just broke? Because when established relationships fail, markets are telling us something deeper. To answer that, we need to examine the structural signals emerging beneath the volatility. And that is where the next chapter begins. For decades, many investors have relied on a basic framework: When banking stress rises, gold strengthens. When confidence in financial institutions weakens, silver follows. The logic feels intuitive. If the system looks unstable, capital seeks refuge outside that system. Yet in this episode, that relationship inverted at least temporarily. Bank headlines turned negative. Funding concerns resurfaced. Volatility increased. And instead of rallying, gold and silver dropped sharply. To understand why this feels abnormal, we need to define the rule more precisely. The traditional rule is not just fear equals gold up. It is more specific. It assumes that systemic risk increases demand for non-bank assets. It assumes that investors move from credit exposure into hard assets when confidence deteriorates. That rule works when the fear is about solvency. It breaks when the fear is about liquidity. Solvency concerns are long-term. They question whether assets are worth what they appear to be worth. Liquidity concerns are immediate. They question whether obligations can be met today. In a solvency crisis, gold often rises because investors anticipate monetary response and long-term currency dilution. In a liquidity squeeze, gold can fall because participants need cash now. This distinction is not theoretical, it is mechanical. Modern financial institutions operate inside a dense web of derivatives and collateral agreements. Large banks hedge interest rate risk, currency exposure, and credit risk using contracts that require daily margining. These contracts are marked to market continuously. When volatility rises, margin requirements increase. When asset prices move sharply, collateral calls are triggered. If a bank or hedge fund cannot post additional collateral in cash, it must sell assets to raise it. This is where the rule bends. Which assets are sold first? Not necessarily the worst ones, the most liquid ones. Liquidity is a ranking system. Assets that can be converted into cash quickly, in size, with minimal friction, are preferred for raising funds. Gold futures and silver futures fit that description. They trade in deep, global markets. Positions can be reduced instantly. Settlement is standardized. In contrast, private loans, structured credit products, or long-duration securities may be difficult to sell quickly without steep discounts. So when collateral demands increase, institutions look at their balance sheets and ask a practical question: what can we sell right now? The answer is often the most liquid exposure. This is why forced selling can target defensive assets. It is not a vote against their long-term value. It is a reflection of short-term funding stress. Margin calls are not optional. They are contractual obligations. If not met, positions are closed automatically. Losses are realized. Counterparties seize collateral. In highly leveraged environments, small price movements can trigger large adjustments. Consider a simplified example. A fund holds a diversified portfolio: bonds, equities, gold, futures. It finances part of that portfolio using borrowed money. If bond prices decline and volatility increases, lenders demand additional collateral. The fund must raise cash quickly. Selling bonds into a falling market may deepen losses. Selling gold futures may be faster and cleaner. The gold sale is not ideological, it is tactical. Multiply that dynamic across multiple institutions and you create synchronized selling. This is how patterns break. In stable markets, gold may rise during stress because investors voluntarily allocate more capital to it. In funding stress, gold may fall because institutions involuntarily reduce exposure. The difference lies in agency. Voluntary flows follow narrative. Forced flows follow necessity. The flash crash suggests that necessity was in control. There is another layer to this dynamic: balance sheet constraints. Banks do not operate with unlimited flexibility. They face regulatory capital requirements, leverage ratios, and liquidity coverage ratios. When asset values fluctuate, those ratios shift. If regulatory buffers shrink, banks must adjust. Sometimes adjustment means reducing risk-weighted assets. Sometimes it means shrinking trading books. Sometimes it means selling liquid positions. If funding markets show signs of strain, banks may preemptively reduce exposure to preserve capital. That reduction can cascade into futures markets. Again, The selling is not a judgment on gold's intrinsic value. It is a response to systemic pressure. Derivatives amplify this effect. The global derivatives market is enormous. Interest rate swaps, currency forwards, options, futures all are interconnected. These instruments are designed to transfer risk, but they also create chains of collateral obligations. When volatility spikes, those chains tighten. One institution's margin call becomes another institution's liquidity demand. The network transmits pressure rapidly. In such an environment, correlations that usually hold can temporarily invert. Gold and equities may fall together. Bonds and metals may decline simultaneously. The common factor is not asset class, it is liquidity demand. This phenomenon has appeared before. During past liquidity squeezes, defensive assets initially dropped before recovering. The pattern tends to follow a sequence. First, funding stress emerges. Second, leveraged positions are reduced. Third, central banks respond or markets stabilize. Finally, longer-term trends resume. We are not claiming history repeats exactly, but the structure of funding markets creates recurring dynamics. When cash becomes scarce, everything competes for it. This is the deeper signal embedded in the flash crash. The visible event was a rapid decline in metal prices. The invisible event was a scramble for dollars. Why dollars? Because the dollar remains the primary settlement currency in global finance. Many cross-border contracts are denominated in dollars. Many commodities are priced in dollars. Funding markets clear in dollars. If access to dollar liquidity tightens, institutions worldwide feel the impact. A European bank with dollar liabilities must secure dollars to meet obligations. A multinational corporation with dollar-denominated debt must manage funding exposure. A hedge fund trading global assets may rely on dollar-based financing. When stress builds, demand for dollars rises. That demand can strengthen the dollar in the short term. It can also pressure assets that are sold to obtain dollars. This is why the metal price alone is not the central story. If gold drops because inflation expectations fall, that is one narrative. If gold drops because real yields rise, that is another narrative. But if gold drops because institutions need cash to satisfy margin calls, the signal points elsewhere. It points to funding conditions. Funding conditions are often measured through indicators like interbank lending rates, repo spreads, swap spreads, and cross-currency basis swaps. These are technical metrics rarely discussed in mainstream coverage. Yet they reveal stress before equity markets react. If spreads widen and borrowing costs increase, liquidity is tightening. When liquidity tightens, when leverage unwinds, liquid assets are sold. The flash crash may be telling us that leverage somewhere in the system is being reduced. That reduction could be modest and contained, or it could signal broader caution among large institutions. The key is that this dynamic breaks the surface rule of bank stress equals gold up. Instead, it reveals a hierarchy. At the top of the hierarchy is immediate liquidity. Below that are assets. When the system is calm, assets are accumulated. When the system is strained, assets are exchanged for liquidity. Understanding this hierarchy transforms the way we interpret volatility. It also reframes what abnormal really means. The move felt abnormal because many participants were anchored to a simplified narrative. Gold equals fear hedge. Silver equals inflation play. Bank stress equals metals rally. But markets are multi-layered. There is macro narrative. There is investor psychology. And there is funding mechanics. When these layers align, price action looks clean and intuitive. When they diverge, confusion emerges. The flash crash reflects divergence. Macro headlines suggested rising stress. Psychology suggested defensive positioning. Funding mechanics demanded cash. Mechanics 1. This realization leads to a more important question. Is this an isolated funding adjustment, or is it part of a broader tightening cycle? To answer that, we need to look beyond metals. Are other liquid assets showing similar stress? Are short-term funding rates rising? Are central banks signaling concern? Are banks reducing balance sheet exposure? If multiple indicators point toward tighter liquidity, then the metal drop becomes contextualized as one expression of a larger shift. If not, it may represent a temporary positioning flush. Either way, the key takeaway is clear. Markets do not move based on ideology. They move based on constraints. When constraints tighten, positions shrink. When positions shrink, correlations change. The breaking of a familiar rule is often the first clue that constraints have shifted. Gold falling during bank stress is not necessarily a contradiction. It may be confirmation that funding markets are under pressure. And that brings us to the central insight of this chapter. The big signal is not the metal price. It is the scramble for dollars. When institutions prioritize dollars over hard assets, it reveals stress in the monetary plumbing. It suggests that the demand for immediate settlement capacity has risen above the demand for long-term protection. That hierarchy shift is subtle but powerful. It means the story is no longer just about precious metals. It is about who controls liquidity, who needs it most urgently, and how that need reshapes global flows. To understand the full implications, we must examine where real leverage sits, not just in trading screens, but in supply chains, reserves, and settlement systems. Because once funding stress interacts with physical constraints, the dynamic changes again, and that is where the real battle begins. If the scramble for dollars is the signal, then the next logical step is to ask a deeper question. Where does real control sit? Not in headlines, not in social media commentary, but in the physical and institutional structure of the gold and silver markets. Up to this point, we have focused on liquidity and funding markets, collateral calls, and derivatives exposure. That is the paper layer of the system. It is fast, it is leveraged, it reacts in seconds. But beneath that layer sits something slower and more tangible. Metal, gold, must be mined, silver must be extracted, or must be processed, refined, transported, assayed, stored, and insured. Physical bars must meet strict standards. They must be acceptable in specific vaults. They must clear through recognized systems. The physical supply chain does not move at the speed of algorithms. It moves at the speed of geology, energy, labor, and logistics. This distinction matters because, during stress events, the paper market can swing violently while the physical layer remains relatively stable. So who actually controls gold and silver supply? Start with mining. Gold production is geographically concentrated. A handful of countries account for a large share of global output. Mining companies invest years in exploration and development before a single ounce reaches market. Silver production is even more complex because much of it is a byproduct of other metals such as copper, lead, and zinc. This means silver supply does not always respond directly to silver prices. It responds to broader industrial activity. Once mined, metal moves to refiners. Refiners transform door bars and concentrate into investment-grade bullion. They certify purity and weight. Only refined bars that meet exchange standards can enter major vaulting systems. From there, metal enters a network of vaults in key financial centers. London is one of the most important hubs for gold storage and clearing. New York plays a central role in futures settlement. Switzerland is a major refining center. Asian hubs have grown in importance as well, reflecting rising demand from the East. These centers are not just storage locations. They are nodes in a global settlement system. Large bullion banks operate within this framework. They facilitate trades between miners, refiners, central banks, institutions, and investors. They make markets in futures and forwards. They provide liquidity. This is where the paper and physical layers intersect. A futures contract represents a claim on metal, but most contracts never result in physical delivery. They are rolled over or closed before expiration. The futures market is primarily a price discovery mechanism and a risk transfer tool. The volume of paper contracts can exceed available physical supply by a significant margin. Under normal conditions, this does not cause instability. The system relies on confidence that only a small fraction of participants will demand delivery at the same time. But during stress, that confidence can be tested. If paper positions are heavily leveraged and funding tightens, futures prices can move sharply even if physical demand remains steady. Selling pressure in the derivatives market can push prices lower temporarily, regardless of what is happening in vaults. This is the disconnect many observers struggle to reconcile. They see reports of steady central bank buying. They see long-term demand trends. Yet in moments of funding stress, prices fall. The explanation lies in the leverage embedded in the paper layer. Banks and trading firms operate primarily in this paper environment. Their exposures are marked to market daily. Their collateral requirements adjust in real time. Their balance sheets are sensitive to short-term volatility. Mines and refiners operate on a different clock. They negotiate contracts months in advance. They manage production schedules based on long-term investment cycles. They are not liquidating metal within minutes because funding spreads widened. So when financial leverage unwinds, the paper price can detach temporarily from physical fundamentals. This detachment is not permanent, but it can be sharp. To see the leverage points clearly, consider the role of central banks. Central banks hold significant gold reserves. These reserves serve as a strategic asset, a store of value outside the credit system. Central banks do not trade gold in the same way hedge funds trade futures. Their actions are deliberate and infrequent. When private institutions sell gold futures to raise dollars, central banks are not forced sellers. Their balance sheets operate under different constraints. This creates an interesting tension. On one side, leveraged institutions adjust rapidly to funding conditions. On the other side, sovereign holders operate with long-term objectives. The price in the short term reflects the behavior of the leveraged layer. Over longer horizons, it reflects structural demand and supply. Understanding this layered system shifts the narrative away from retail investors versus markets. Retail investors are small participants in a much larger ecosystem. The real battle is not ideological. It is structural. It is liquidity versus collateral. When funding tightens, collateral becomes precious. Institutions must decide which assets to pledge, which to sell, and which to hold. Gold futures can serve as both collateral and liquidity. That dual role makes them sensitive during stress. Meanwhile, physical metal sitting in vaults does not evaporate because futures prices fall. The bars remain. Ownership may shift, but supply does not suddenly expand. This raises another critical question. Who controls settlement? Settlement is the final step in any financial transaction. It is where obligations are fulfilled. In metals markets, settlement can be cash or physical delivery. Large clearinghouses manage this process. They stand between buyers and sellers. They guarantee performance. To do so, they require margin. If volatility increases, clearinghouses increase margin requirements to protect themselves. This forces participants to post more collateral. In a rising volatility environment, the system demands more liquidity from participants. This is another leverage point. When clearinghouses tighten requirements, they amplify the demand for cash. Participants who cannot meet new requirements must reduce positions. Again, liquid futures are often reduced first. Notice how the layers interact. Mining supply does not change in minutes. Refining capacity does not shift in hours. Vault inventories do not disappear overnight. But margin requirements can rise within a day. That asymmetry explains how prices can swing without immediate changes in physical supply. It also explains why headlines can mislead. A sharp drop in gold does not automatically signal collapsing physical demand. It may signal tightening financial conditions. The deeper story, then, is not about whether gold failed as a hedge. It is about where leverage is concentrated. Leverage resides in the paper layer. Power resides in settlement systems. Control resides in institutions that manage liquidity and collateral. When stress emerges, those institutions prioritize stability. They adjust requirements. They protect balance sheets. They secure funding. The visible outcome is volatility. The invisible outcome is a reshuffling of positions. This reshuffling can create temporary distortions. For example, physical premiums in certain regions may remain firm even as futures prices decline. That divergence hints at underlying demand that is not immediately reflected in paper markets. Over time, these layers tend to reconnect. If physical demand remains strong and financial selling subsides, prices can recover. If funding stress deepens and forces broader liquidation, prices can overshoot on the downside before stabilizing. The key insight is that paper and physical markets move at different speeds. During calm periods, they align closely. During stress, they diverge. Recognizing that divergence helps us interpret events more accurately. The flash crash was a paper market event triggered by funding pressure. It does not automatically tell us that mines are producing excess metal. It does not confirm that central banks are selling reserves. It does not prove that long-term demand vanished. It tells us that liquidity was demanded urgently, and in a globally interconnected system, urgent liquidity needs ripple quickly, from London vaults to New York futures exchanges, from Asian refiners to European clearing banks, from commodity desks to central bank reserves. The network is vast. The battle is structural. It is about which layer adjusts first and which layer absorbs the shock. Right now, the adjustment appears to be happening in the leveraged financial layer. But if funding stress persists, it can spill over into other domains. Credit availability can tighten. Currency volatility can increase. Central banks may face difficult choices. And that is where this story widens again. Because once liquidity pressure intersects with currency systems and monetary policy, the consequences extend beyond metals. To understand that next layer, we must shift from supply chains and vaults to money itself. We must examine how liquidity stress affects currencies, inflation expectations, and the long-term credibility of the financial system. That is where the hidden consequences begin to emerge. When we step back from vaults and futures exchanges, a broader question comes into focus. If banks are under stress and institutions are selling metals to raise dollars, what does that reveal about the currency system itself? Because gold and silver do not exist in isolation. They trade inside a global monetary framework. Their volatility is not just about supply and demand, it is about hierarchy. Every financial system operates on layers of money. At the top of that hierarchy sits sovereign currency used for final settlement. In today's world, that primarily means the US dollar. Central bank reserves, interbank transfers, and large cross-border payments ultimately clear in sovereign currency. Below that top layer sit commercial bank deposits. These are claims on banks. They function as money in everyday life, but they depend on the stability of the banking system. Below deposits sit credit instruments, bonds, loans, asset-backed securities. These are promises to pay in the future. Their value depends on both solvency and liquidity. Then come derivatives. These are contracts based on other assets. They are not money themselves, but they create obligations that must be settled in money. Gold occupies a unique position. It is not a liability of any government. It is not a promise to pay. It exists outside the credit system. Yet it trades within the infrastructure of that system. Its price is discovered in futures markets that settle in dollars. This dual nature explains much of its behavior during stress. When funding markets tighten, participants climb the hierarchy. They move from lower-tier claims toward higher-tier settlement assets. In practical terms, that means they seek dollars. The immediate result can be dollar strength. As demand for settlement currency increases, its exchange value rises relative to other assets. This can create short-term deflationary pressure. Commodity prices may fall. Risk assets may decline. Even gold can drop, not because it lost value, but because liquidity preference shifted upward. This dynamic often confuses observers. They expect gold to rise when the system looks unstable. But instability can mean two different things. It can mean long-term loss of confidence in fiat currency, or it can mean short-term demand for liquidity within the fiat system. In the early stages of funding stress, the second dynamic tends to dominate. Dollars are needed to close positions, satisfy margin calls, and secure collateral. Institutions prioritize access to the highest-tier asset. That upward movement in the hierarchy can temporarily suppress lower-tier assets. Yet this is only part of the story. Because repeated liquidity shocks have consequences. When funding stress appears, central banks face a choice. They can allow markets to self-correct through deleveraging, or they can intervene to stabilize liquidity. Historically, central banks have chosen intervention when systemic risk rises. Intervention can take several forms. They can lower policy rates. They can expand repo facilities to supply short-term funding. They can establish swap lines with foreign central banks to provide dollar liquidity abroad. They can create emergency lending programs to support banks facing deposit outflows. Each of these tools injects liquidity into the system. In the short term, such actions can relieve pressure. Funding spreads narrow. Volatility declines. Forced selling slows. Confidence stabilizes. But there is a longer-term implication. If liquidity stress repeatedly requires central bank support, market participants begin to adjust expectations. They may assume that severe tightening will always be met with easing. They may take on risk with the belief that backstops exist. Over time, this can weaken discipline in the system. More importantly, it can reshape trust in fiat currency. Fiat money is based on confidence. It has no intrinsic backing. Its value rests on the credibility of institutions that manage it. If central banks expand balance sheets significantly to counteract stress, the supply of base money increases. If this expansion becomes a pattern, questions about long-term purchasing power can resurface. This is where intellectual tension emerges. In the short term, liquidity stress can be deflationary. Asset prices fall. Credit contracts. Demand weakens. In the longer term, aggressive intervention to counteract that stress can be inflationary. Money supply grows. Real rates may decline. Currency debasement concerns return. Gold sits at the intersection of these forces. During the initial scramble for dollars, it may decline. During sustained monetary expansion, it may rise. Understanding this sequence prevents oversupply. Today's price drop does not automatically negate the long-term argument for hard assets. It may reflect the first stage of a broader cycle. To evaluate that possibility, we must observe how policymakers respond. If funding stress is mild and resolves without large-scale intervention, the impact on currency confidence may be limited. If stress deepens and requires substantial liquidity injections, perceptions can shift. Currency markets are sensitive to expectations. If investors believe future monetary expansion will erode purchasing power, they adjust portfolios accordingly. This adjustment does not happen instantly. It unfolds over time. Another hidden consequence involves global imbalances. Because the dollar functions as the primary settlement currency, stress in U.S. funding markets can transmit globally. Foreign institutions with dollar liabilities may struggle to secure funding. Central banks abroad may rely on swap lines to access dollars. This reinforces the central role of the dollar, but also exposes its fragility. If global participants perceive that dollar liquidity is unstable or overly dependent on emergency facilities, they may gradually diversify reserves. Central banks have already increased gold holdings in recent years. That trend reflects long-term risk management rather than short-term trading. In this sense, short-term dollar strengths and long-term diversification are not mutually exclusive. They can occur in sequence. Liquidity stress drives immediate dollar demand. Policy response and structural shifts influence longer-term allocation decisions. This layered interaction shapes inflation expectations as well. If central banks expand liquidity aggressively, inflation expectations can rise over time. If they hesitate and allow deleveraging to proceed, short-term deflationary forces may dominate. Markets constantly assess this balance. Gold and silver respond to real interest rates, currency trends, and expectations about policy credibility. When we interpret metals volatility through this broader lens, the flash crash becomes one moment in a larger monetary narrative. It is not simply a technical event. It is part of a dynamic tension between liquidity preference and purchasing power concerns. The hidden consequence is not today's price drop. It is how repeated cycles of stress and intervention alter trust. Trust in banks, trust in central banks, trust in fiat currency systems. If trust remains intact, volatility may fade without lasting structural change. If trust erodes gradually, asset allocation patterns can shift over years. This is why the hierarchy of money matters. At the top sits sovereign currency used for settlement. Below it sit bank liabilities and credit claims. Gold stands outside as a non-liability asset, yet it trades within the framework shaped by those liabilities. When stress forces participants upward in the hierarchy, gold can be sold. When confidence in the hierarchy itself weakens, gold can be accumulated. Recognizing this duality is essential. It prevents reactive thinking. It encourages structured analysis. The present moment reflects upward pressure in the hierarchical scramble for top-tier liquidity. But if interventions expand balance sheets and alter long-term expectations, the hierarchy may look different in the years ahead. This evolving balance between short-term deflationary pressure and long-term structural inflation risk is where the real tension lies. And that tension does not remain abstract. It filters down to households, businesses, savers, and workers. To understand how, we must translate this macro framework into everyday impact. That is where the next chapter takes us. When we talk about currency hierarchies, central bank balance sheets, and funding markets, it can feel distant from daily life. But the consequences are not distant. They move quietly through retirement accounts, savings deposits, mortgage rates, and the price of everyday goods. So, instead of staying at the macro level, we need to translate what we have discussed into practical understanding without turning it into prescriptions or trading advice. The goal here is clarity, because volatility creates emotional pressure, and emotional pressure often leads to poor interpretation. To stay grounded, we can rely on a few simple mental models. The first is this: liquidity first, assets second. In times of stress, large institutions prioritize access to cash over the long-term value of what they hold. This does not mean assets are worthless. It means timing matters. If you understand this hierarchy, a sudden drop in gold during banking stress looks different. It no longer feels like a contradiction. It looks like a funding response. This mental model applies beyond metals. If equity markets fall sharply during a credit event, it may not mean businesses suddenly became unproductive. It may mean leveraged positions are being reduced. Liquidity first, assets second. The second model: paper markets move faster than physical reality. Most people experience the economy physically. They see prices at grocery stores. They see home values in their neighborhoods. They see employment conditions. Financial markets, however, move digitally and instantly. Futures contracts can change value in milliseconds. Options prices adjust in real time. Algorithms respond to headlines before humans finish reading them. This speed difference creates gaps. Gold futures can fall rapidly while jewelry demand remains steady. Equity markets can swing wildly while factories continue operating normally. Understanding this separation helps reduce overreaction. Paper markets reflect expectations and funding conditions. Physical reality adjusts more slowly. The third model: stress reveals system priorities. During calm periods, institutions talk about long-term strategy, sustainability, and growth. During stress, priorities simplify. Meet obligations, preserve liquidity, protect capital ratios. Watching what gets sold during a crisis tells you what institutions need most urgently. If high-quality liquid assets are being reduced, it suggests immediate funding pressure. If central banks expand facilities quickly, it suggests concern about systemic stability. Stress strips away narratives and exposes incentives. The fourth model: volatility is often about funding, not fundamentals. This is perhaps the most important concept. Fundamentals change gradually. Corporate earnings evolve over quarters. Mining supply adjusts over years. Demographics shift over decades. Funding conditions, by contrast, can change in hours. A spike in margin requirements can trigger selling unrelated to long-term value. A shift in repo rates can force institutions to rebalance portfolios quickly. When volatility appears, asking whether it reflects a change in fundamentals or a change in funding conditions is crucial. Now let's connect these models to everyday impact. Consider retirement accounts. Many retirement portfolios hold a mix of equities, bonds, and sometimes commodities or precious metals exposure. When markets experience funding-driven volatility, account balances fluctuate. For individuals watching these balances, the emotional impulse can be strong. But if the move is driven by short-term liquidity pressure rather than long-term earnings collapse, the interpretation changes. The same applies to bank deposits. When headlines mention banking stress, depositors may worry about safety. In most developed systems, deposit insurance and central bank facilities are designed to maintain confidence. Yet, if funding stress persists, banks may tighten lending standards. Credit availability can shrink quietly. Mortgages become harder to obtain. Business loans carry stricter terms. Credit card limits may be adjusted. This is how macro stress filters into household decisions, not through dramatic announcements, but through incremental tightening. Currency purchasing power is another channel. If central banks respond to stress with aggressive liquidity expansion, the long-term supply of money can increase. In the short term, this may stabilize markets. In the long term, it may influence inflation dynamics. For households, this shows up in subtle ways. The cost of services may rise, insurance premiums may increase, education and healthcare expenses may trend higher. These shifts do not happen overnight, but they accumulate. Understanding the link between liquidity cycles and purchasing power helps contextualize both short-term deflationary scares and long-term inflation concerns. It also reinforces an important point. A drop in gold during banking stress does not automatically invalidate its long-term thesis. If the drop reflects leverage unwinding, it may say more about funding markets than about currency debasement risk. Long-term theses unfold across cycles. Short-term volatility often reflects mechanical adjustments. Separating these time horizons is essential. Another practical implication involves employment and corporate behavior. If banks face prolonged funding pressure, they may reduce lending to businesses. Companies reliant on credit may slow expansion plans. Hiring may soften. We have moved from the flash crash itself to the plumbing beneath it, from supply chains to currency hierarchies, and finally to the personal frameworks that help us interpret volatility. The remaining question is forward-looking. What happens next? There are several plausible paths, and none of them require certainty to analyze. The first scenario is stabilization. Liquidity pressure eases, funding markets normalize, margin requirements stop rising, banks regain confidence in short-term borrowing channels. If this occurs, forced selling subsides. Metals can recover as the scramble for dollars fades. In this path, the flash crash becomes a sharp but temporary, event-an adjustment driven by leverage, not by structural breakdown. The second scenario is deeper stress. If funding conditions continue tightening, forced selling may extend beyond metals, equities, credit markets, and even sovereign bonds could face additional pressure. In this case, volatility spreads, liquidity becomes more selective. Institutions prioritize balance sheet defense over expansion. The signal to watch would be persistent strain in short-term funding indicators and widening credit spreads. The third scenario involves aggressive intervention. Central banks may expand liquidity facilities, reopen swap lines, or introduce emergency lending tools to stabilize confidence. Short-term pressure would likely ease, but longer-term, repeated intervention could reshape perceptions of currency stability. In that environment, demand for hard assets may strengthen over time, not because of immediate panic, but because of gradual shifts in trust. None of these outcomes are guaranteed. The key is not prediction, it is signal recognition. Are funding markets calming or tightening further? Are banks shrinking balance sheets or expanding them? Are central banks reacting defensively or proactively? These indicators matter more than a single day's price action. And this leads to a final tension point. If gold and silver are being used as liquidity buffers during stress sold quickly to meet obligations, what happens if physical supply tightens at the same time funding pressure persists? What happens if the paper layer needs collateral, but the physical layer cannot expand fast enough? That unresolved question suggests the flash crash may not be an isolated anomaly. It may be an early chapter in a broader structural shift. And that shift is what we will examine next.